One man, one keyboard, one clumsy click. And in the time it takes to microwave a burrito, $1 trillion evaporates from the American stock market. What actually happened on the afternoon of May the 6th, 2010, is stranger, slower to untangle, and a lot more uncomfortable. The $1 trillion was real. The crash was real. But the click everyone blames took 5 years, 3 continents, and a very confused FBI to track down. And when they finally found it, it was hiding in a semi-detached house under the Heathrow flight path, belonging to a man who traded in his socks. This is the flash crash. And it is less a story about a villain than about the machine that needed one. To understand how $1 trillion can vanish in 5 minutes, you first have to know who was actually doing the trading. By 2010, the answer was almost nobody, at least nobody human. Somewhere in the last decade, the New York Stock Exchange stopped being a room full of shouting men and quietly became a warehouse full of servers. The fastest traders on Earth were no longer people, they were algorithms. Programs run by firms most of us have never heard of, buying and selling in millionths of a second. These machines don't invest. They have no opinion about whether a company is any good. They buy something and sell it a heartbeat later, thousands of times a second, skimming a fraction of a cent each time. Do that often enough, and the fractions become a fortune. It is the most boring way ever invented to make an absolute killing. No genius, no gut instinct, just a machine hoovering up half pennies a few million times a day. The whole system leans on one quiet assumption that whenever a machine wants to sell, another machine will be there to buy. That, the other side of the trade, always exists. Hold on to that assumption. In about 90 seconds of screen time, it's going to break. 2:32 in the afternoon, Eastern Time. May the 6th, 2010. The market is already having a bad day. Greece is on fire. Meanwhile, actual riots in Athens over the debt crisis are running on the news. Stocks are down about 3% before lunch is even settled. Everyone is nervous. The machines can feel it too. Into that nervous market, a mutual fund company in Kansas, Waddell & Reed, presses go on a perfectly ordinary hedge. It wants to sell 75,000 contracts of something called the E-mini S&P 500. Think of the E-mini as a single bet on the entire American stock market, the most heavily traded contract of its kind in the world. The order is worth about $4.1 billion. That alone isn't the problem. Big funds sell big positions all the time. The problem is how they told the computer to do it. The program was set to sell based on how much was trading. The more volume in the market, the faster it should offload. Not based on price, not based on time. Just, the busier it gets, sell quicker. On a calm day, fine. On this day, it lit a fuse. Here's what nobody designed and everybody built. The high-frequency machines bought those contracts exactly like they're supposed to, but they didn't want to hold them. Holding is risk. So within milliseconds, they sold them on to each other. The same contracts, flung from one algorithm to the next and back again, faster and faster. A hot potato that no machine wanted to be caught holding. If the machines could talk, and mercifully, they can't, the whole conversation went something like this. Bought it. Don't want it. You take it. Don't want it either. You take it. Now run that back a few thousand times a second between computers that never blink, and you've got the world's fastest game of pass the parcel with a $4 billion parcel. And this is the trap. All that frantic passing around counted as volume. And the Kansas selling program was watching volume. So it saw the frenzy, decided the market was busy, and did exactly what it was told. It sped up. More selling made more volume. More volume made more selling. The machine was now feeding itself. 2:42 p.m., the floor drops out. In roughly 5 minutes, the Dow falls another 600 points, on top of everything it had already lost. briefly down almost 1,000 points on the day, the fastest plunge in its history. And then the assumption from Act 1 finally snaps. The buyers vanish. There is no other side of the trade, just a void. When the machines can't find a real buyer, they don't switch off. To stay technically present in the market, some post what are called stub quotes, placeholder offers no one is ever meant to accept. An offer to buy a share for a single penny. An offer to sell one for $100,000. On any normal day, those numbers just sit there, ignored. But in the void, they were suddenly the only prices left, so the trades happened at them. For a few surreal seconds, Accenture, a real healthy multi-billion-dollar company, traded for 1 cent. Other blue chips briefly changed hands at $100,000 a share. The market wasn't valuing these companies anymore. It had simply lost the ability to know what anything was worth. And then a piece of plumbing nobody ever talks about saved Wall Street from itself. At 2:45 and 28 seconds, deep in the freefall, the Chicago Exchange's automatic circuit breaker, a system called Stop Logic, tripped and froze trading in the key contract. Not for an hour, not for a minute, for 5 seconds. And 5 seconds was enough. The machines paused, the humans caught a breath, and buyers crept back into the void. By 3:08 p.m., most of the $1 trillion had returned. Start to finish, the whole collapse and recovery took about 36 minutes. There was no crash headline to explain it, no bankruptcy, no attack, no announcement. The market had tripped over its own shoelaces at the speed of light, face-planted, and stood back up before most of the humans in the building understood what they just watched. The regulators were baffled. It took the SEC and the CFTC 5 months to publish a report, and when they did, it pointed at that Kansas algorithm colliding with the high-frequency machines. A systems failure, a freak accident of design. Case more or less closed. Except a story about $1 trillion needs a villain. And 5 years later, they found one. April 2015, the Department of Justice announces an arrest in the flash crash. Not a Wall Street bank, not a hedge fund with a glass tower. A 36-year-old man taken from his parents' modest house in Hounslow, West London, directly beneath the planes landing at Heathrow. His name is Navinder Sarao. The press will call him the Hound of Hounslow. He trades alone from his childhood bedroom, wearing the kind of ear defenders road workers use because he can't stand noise. He is brilliant with numbers, ranked among the top 200 FIFA players on Earth, and almost incapable of small talk. His stated ambition was to out-earn Warren Buffett. His own parents had no idea he was a multimillionaire. And the prosecutors say this man helped cause the crash. But here's where the fat finger story finally falls apart. Sarao didn't make one bad click. He made hundreds of thousands of orders that he never intended to complete. The trick is called spoofing. And once you see it, you can't unsee it. Sarao would place enormous sell orders, huge walls of them, stacked just above the current price. To every other machine watching the screen, it looked like a tidal wave of selling was about to hit. So they did the rational thing. They sold first to get ahead of it, dragging the price down. And the instant before his own giant orders could actually execute, Sarao canceled them. Everyone. The wave was never real. He'd just scared the market into moving, then bought back in at the lower price he'd manufactured. And the wild part? Someone actually noticed. Once. Weeks before the crash, an official at the Chicago Exchange spotted Sarao's giant orders blinking in and out and sent him a note asking him to knock it off. Sarao wrote back, and these are close to his actual words, that he was just showing a friend what happens on the bid side of the market 24 hours a day, thanks to the high-frequency geeks. Then he asked whether this meant the exchange would also be shutting down, quote, the mass manipulation of the high-frequency nerds. 3 weeks later, for good measure, he phoned them back and told them his words, to kiss his ass. nobody stopped him. Nobody stopped the high-frequency nerds either. He did it so many times, he had custom software built to place and yank the phantom orders automatically. On the afternoon of May the 6th, prosecutors said his ghost orders were part of the pressure that helped tip an already teetering market over the edge. Here's the detail the legend always leaves out, though. On the afternoon of the crash, Sarao set his phantom orders running. Hundreds of millions of dollars of sell orders he had no intention of honoring. And then his mom called him down for dinner. So he went. His program switched itself off about a minute before the market truly fell off the cliff, which means the man the US government would later accuse of vaporizing $1 trillion spent the actual crash having dinner. And when academics later rebuilt that afternoon, millisecond by millisecond, they found his orders accounted for only a sliver of the fall, a fraction of a move driven by everyone and everything else at once. His personal take for the whole afternoon came to about $879,000, a rounding error in $1 trillion wound, part of. And that's the honest, unsatisfying truth economists still argue about. Was it Sarao? The Kansas algorithm? The hot potato machines? The whole fragile structure? Realistically, all of them at once, but you cannot handcuff a market structure. You can handcuff a man in a tracksuit. So he became the face, because a face is so much easier to prosecute than a system. And now the part the fat finger legend always leaves out. Over his career, Sarao made, depending on who's counting, somewhere between $40 and $70 million. He kept almost none of it. He wasn't spending it on yachts. He barely spent it at all. Still living in the same childhood bedroom? Still riding a moped to the same McDonald's. Instead, he handed the fortune to a string of offshore investment schemes that promised him spectacular returns and simply stole it. The man accused of outfoxing the smartest machines on Wall Street turned out to be one of the easiest marks in Britain. When they finally arrested him, he couldn't even make bail because the money was already gone. He pleaded guilty. He cooperated with the government for years. And in 2020, the judge sentenced him to 1 year, not in a prison, but of home confinement. Which is to say, they sent the Hound of Hounslow back to the exact bedroom he'd started in. Because the click was never really the point. The uncomfortable thing the flash crash exposed isn't that one strange man in London found a lever. It's that the lever existed at all. That a market this fast could be nudged into losing $1 trillion by forces nobody fully controlled and nobody fully understood. Afterwards, they added circuit breakers, automatic timeouts that halt trading when a price falls too far, too fast. A button that says, "Everybody stop, we'll breathe." Those breakers have been tripped many times since. There have been more flash crashes. In 2013, when a single hacked news tweet erased hundreds of billions in seconds. In currencies, in individual stocks, the machine keeps finding new ways to trip over itself. So here's where we actually landed. We built a market that can lose $1 trillion faster than you can read this sentence, then patched it with a button that says, "Time out." The Hound of Hounslow got 11 months in his childhood bedroom. The machine that made him matter didn't even get a warning. If you want the story of the tweet that wiped out $130 billion in 3 minutes, that one's already on the evidence board. I'm Capital Detective. Case closed.